Hello, and welcome back to Accounting 212. Today we're going to be talking about Chapters 2 and Chapter 6. I've gone ahead and I've kind of cut down some of the PowerPoint slides into really the main important parts of the chapters that I want to cover. I combined the two chapters mainly because they're talking about the same thing, the building blocks of managerial accounting, and really how our different costs in our companies and our businesses, how they behave and how we're able to use the idea of how these costs behave to be able to predict and make business decisions based off of the information we are given today. So we'll get started here. We'll go through starting with Chapter 2, and then we'll switch over to Chapter 6. Just keep in mind as we go through this, this is not all the slides. I tailored down the PowerPoints in this narrated presentation for really the key points, but they're all the full version of the PowerPoints, unedited from the publisher, are available on the My Courses site for the class. So you can go ahead and download those and have those as you're doing homework or quizzes or as you're getting ready to study for the exam in the next couple weeks. So we'll get started here, Chapter 2. So our first learning objective here is to really just talk about our couple different types of companies that we might encounter. So we have service, merchandising, and manufacturing companies that we'll be looking at, and as we go through the chapter, some of the examples you'll see is the three different types of companies, and we'll be able to distinguish and identify what types of businesses those are. So we start here, again, with our three main types of businesses, and we'll start with our first one, service companies. So here, it's really the biggest sector of the U.S. economy. We can see here that they sell intangible services. So we're going to these businesses, and I'm sure everyone here has worked with them or identified them or maybe possibly does this business with them, or maybe is an employee or hopes to be an employee of one of these types of businesses. But we can see here we sell intangible service, so we're not going to one of these companies and getting a piece of property. We're not walking out with a computer or a car, etc. Really, we're selling information for the most part. So we have examples here: healthcare, insurance, banking, and consulting. So our largest sector of the U.S. economy, and then there's no inventory that these types of businesses are going to be selling. All right, so we're selling the thoughts, the idea, maybe access. We're selling a service. An additional item here that is related to a service company, additional example would be the airline industry. Again, we use this, we get a service, we go from point A to point B, Boston to Chicago, etc. But when we're done with this service, after we've paid for our experience, we're not left with anything tangible. We're just left with the flight. That's the service we are buying. So there's no inventory. They might have prepaid supplies that they use, but we're not going to these businesses to buy some sort of tangible property. So there'll be no inventory on the balance sheet. Next, we have merchandising companies or retailers, as I'm sure most of you have heard of these. These are ones that we deal with a lot. They resell tangible products bought from manufacturers and suppliers. So they are be kind of the intermediary between the suppliers, the manufacturers who make the products, and the end user, the consumer. So examples there: Walmart, Best Buy. You drive down the road and you see tons and tons of these merchandising companies. There are retailers and wholesalers, so just depending on really generally the size of the purchase that the consumer is making. Generally, a wholesaler will sell to other retailers who then sell to the end user. So those are usually kind of another step in the merchandising company, the business model. And generally, a retailer, a merchandising company, is going to have a significant amount of inventory in their store, on their balance sheet, at their location, etc. And that's because generally, if you think about a retailer, if you go into say, Walmart, you want the product to be there on the shelves. That's why you're going to that store. You want to be able to go in, buy your stuff, and then leave. So these businesses need to carry a substantial amount of inventory, and they have to look at budgeting and forecasting, and they try to predict out what their customer base, what their location is going to be selling in the next week, 2 weeks, etc. That way they have that inventory on hand. I'm sure all of us have gone into a store, they don't have that product, so you have to leave, maybe go to a different store. Maybe you don't go back to that store because you weren't satisfied with their inventory selection. So with retailers, when we look at their balance sheet, and if you guys ever go on, if you work for a retailer, if you work for an accounting firm where you're working on retailers, or if you're bored and you want to go on the SEC website and download, the Best Buy financial statements, the Walmart financial statement, the Target financial statements, just go look at how big of an investment they have in inventory. That's generally where a lot of their money are spent. That's where a lot of money is tied up. because they need to buy that inventory to have available to sell to their customers. Lastly, we have our manufacturing companies, and those are basically the companies that use labor, plant, and equipment to convert raw materials into a finished product. So manufacturing companies, they start with a raw material, they do some work to it, they have it go through their process, their plant, etc., and it turns out and it gets converted into a finished product that they go on and sell to consumers or to those retailers and wholesalers who then sell it to the end user, the final customer, the general public. Examples of these, Toyota, we'll have some more examples in another slide. But you can see we have 3 different types of inventory. So we have raw materials, the stuff we buy right from our vendor for a manufacturer. We have work in process, which, if you guys remember back from your Accounting 211 class, that is the inventory that we've started doing some work on, but it's not yet 100% ready to sell. And then we have lastly that finished goods category, which is we've taken our raw materials, we've done our manufacturing to it, and it's now ready to be sold. We're just looking for and waiting for that customer. So here we have, and this is a really good slide. I would suggest kind of saving it or starring it in your notes. It'll help out with your homework with one of the problems. But we can see here it really gives you a breakdown. We have our service companies with some examples, and you can see airlines, banking, insurance, investing. All companies, all types of businesses that we are getting a service from. We're not buying anything tangible from them. We're getting, in the form of insurance, we're getting a safety net if something goes wrong in our life or in our home or in our business. Investing advice, banking, and then a service. We get an airline. We're not going there to buy anything in particular. We're really getting access to their information or their service that they provide to us. So its primary output is intangible, and again, there's no inventory that we go there to buy. Merchandising companies, Amazon, Best Buy, Walmart, Home Depot, and again, these are all companies that sell tangible products, but they do not necessarily manufacture those products. They're buying the products that they have at that store or their website from someone else. And again, they have one type of inventory, so that's a good indication when we're looking at merchandising versus manufacturing companies. Merchandising companies will have one category of inventory. Manufacturing companies, they're going to have a bunch: raw material, work in process, finished goods. And we can see our examples there: P&G, General Mills, Apple, Toyota. And again, they're creating a new tangible products from other materials. So they're putting them all together. They're taking raw material, metal, plastics, maybe some other types of products, mashing those all together into a new type of product. That's the basic definition of manufacturing. And if you can think about some of these companies that are listed here, say Apple. Yeah, they actually probably could be considered a merchandising company if you think about the Apple stores, or Toyota if you think about a Toyota dealership, as well as service companies. They repair those products that they're selling. So generally, as businesses get larger and larger, a way for them to grow their market share, and once they've saturated really their marketplace, they might go ahead and say, well, rather than us manufacturing and then selling it to someone else, so Apple decided rather than making a computer and then having Best Buy sell it, I'm still going to have that as a business model, but I'm also going to open Apple stores where you can go and buy Apple products made by Apple in an Apple store with Apple employees, and we can also do repairs there. So they've really crossed over, and generally a lot of companies, as they grow larger and larger, especially some of these big manufacturers, these publicly traded manufacturers, they're going to want to get their hands on multiple different service lines to bring in new avenues for revenue growth. So next we're going to look at what makes up a direct cost versus an indirect cost. So we start when we're talking about a direct or an indirect cost. The first thing we really have to identify or look at, and if we're doing a homework problem or a quiz, we have to identify what's the cost object. What are we trying to trace costs to? Because with the cost object, depending on what we have for our cost object, and we can see some examples there, it's going to change, it's going to have an impact on what we say is a direct or an indirect cost. So just the first thing we want to identify is what's the cost object, and that's really anything for which a manager wants to know the cost of. And it can be a individual unit, so one individual product. So if we're talking about Toyota, it could be one car. Different models, so it could be the Corolla versus a Camry versus a RAV4, etc. We can have different alternative marketing strategies, geographic business segments, departments of a same location, or sustainable initiatives. So we can have different cost objects, and we can look at how are some of our costs, how is some of the money we're spending being used, and can we trace it to an individual cost object. So the more information and the more cost objects, or depending on what we're trying to figure out, we might identify at a broad kind of cost object. So that might be the whole geographic location, all of New England. What's my cost for that all of New England, to serve all of New England? Or we might say, what's the cost of one individual item, one individual car? So as a manager, when we're going through and we're trying to make decisions, we might have some different cost objects and therefore trace costs differently. So once we identify our cost object, we then go to look to allocate our costs. And we have two different ways, two different costs kind of breakdowns. We have our direct cost, which is a cost that can be traced to the cost object. So that is a cost that's readily associated with the cost with that cost object. So really, when we're talking about a direct cost, and really what we want to do is we want to identify our cost. And if it's a direct cost, by our definition, which we'll talk about here, and I kind of go with two questions we ask ourselves. And if we can identify it as a direct cost, it's a direct cost, and that's how we classify it. If it doesn't satisfy the definition of the direct cost, basically it's an indirect cost. So as long as you know what a direct cost is, and you can say yes or no, it is a direct cost. If you say yes, great, work's done. If you say no, it basically has to fall into the category of the indirect cost, which is basically a cost that you can't actually specifically trace to the cost object we're talking about. So when we're talking about direct or indirect costs, you really want to ask yourself, number one, can I easily trace and conveniently trace this item or this cost to the cost object? So what you're saying there is, in real life, can we actually easily say that, yes, this cost goes to this individual car, if that's our cost object? Or does this cost identify to this individual location or department, etc.? So if we can easily and conveniently trace the cost to the cost object, that makes it a direct cost. Because what we want to do in accounting is, yes, we want to identify our costs and understand where we're spending our money to make money, but we don't want to spend our time identifying each individual little cost. If it's easy and convenient to trace it to basically the final product or that department, yes, we want to do that. But if it's going to take 10 hours to identify, or the records that we have to create to identify that cost as a direct cost, we don't want to spend that. We don't want to spend more time to figure out the cost. We don't want to spend more cost to figure out a cost, basically. So we have to have, is it easy and convenient to trace to the cost object? And then also, number two, is there a significant dollar amount in there? So generally, again, if it's easy and convenient to trace, it's generally going to have a large price tag on that, or a significant price tag, and that's going to depend on a business by business. But really, if you can answer both of those questions yes, it's a direct cost. If either one of them is no, chances are it's an indirect cost. What you really want to focus on is that, is it easy or convenient to trace? And then you kind of ask yourself, is it a significant dollar amount? So my example there, if you think about building a house, some of the direct costs involved in building a house, the wood, the lumber, the builders, the contractors who are building it. But if you start thinking about the amount of nails or screws that go into building a house, yes, you might be able to kind of easily or conveniently trace it, but there's not going to be an individual screw. It's not going to be a significant dollar amount. Therefore, we're going to include it in that indirect cost, and it basically goes into a cost pool that we will identify and allocate later. And that gets into chapters 3, chapters 4, chapters 5 in this semester as we go through. So right now, though, we just want to identify, is it direct or is it indirect? So convenient, easy to trace, significant dollar amount. If no, it's indirect. If yes, it's direct. So next we'll go through and we'll identify our cost as period costs or product costs. So for our internal decision making, when we're thinking about the cost associated with running a plant, running a business, running a location, what we really want to make sure, we want to understand the total cost, and that's all the resources that are used throughout the value chain. Why we want to know our costs, why it's so important for a business to know its costs, is really, if you don't understand how much it costs to stay in business and how much it costs to bring on a new product or a new service, it's hard for decision makers to make any sort of decision of whether or not we actually want to go to market with this new product or new service. So we want to first identify all the costs within the value chain. And if you guys aren't familiar with the idea of a value chain, it's basically everything involved in bringing a product or service from the kind of thinking about the thought stage, the R&D stage, where we're thinking about, yes, I want to come up with this new product or service. Then I have to think about how I'm going to develop this new product or service, how am I going to bring it to market, and all the way to when we're bringing that product or that service to our final customer. So it's that entire cost from beginning to basically the end. So we want to capture all that cost, because when we're trying to think about that new product or service, we have to understand, can we actually provide it with our resources? Do we need to buy new things? Do we have to hire new employees? So we have to make sure we identify all the costs associated with it. And then we have to understand, if it's going to cost us X, are we going to be able to charge enough to make actually a profit? Because in the business world, if we have this great product or great service, but based off of all of our costs, we can't bring it to a price point that our customers are going to pay for, well, it really doesn't make sense to really continue in going forward. So we have to identify all the costs so we can know if it's a good venture to undertake in order to make a profit. And that's what all businesses are in the business of doing, making profits for their shareholders to grow their wealth. Now, you might say, well, a nonprofit might have a different avenue or a different purpose, but still we want to identify all of our costs. That way, yes, we might not be in the business of making money, but we still want to be able to identify all those costs. So that way, while we might not want to make a profit and become gazillionaires, we still want to identify them, so that way we can cover those costs and find the sources to pay for those costs at the very least to have a break even. So costs for external reporting. So for GAAP, which is what we covered in Accounting 211, we have to break our cost under product or into period costs. So product cost is a cost that's incurred, and if we're talking about a manufacturer, it's the costs that are incurred to produce their products. For a merchandiser, that's the cost to purchase our products. So when we're talking about product costs, it has to relate to the manufacturing process, if we're a manufacturer, or the purchasing of our inventory. And by the purchase of our inventory, we're only talking about the inventory cost. So that's not the cost or the salary for the purchaser. That would not be a product cost for a merchandiser. It's the cost of the product. So how much we bought it from our vendors for. That's what we're talking about. Period costs, those are not treated as inventory. They're immediately expensed. So if we're talking about a period cost, if we talk about the flow of costs into our financial statements, a period cost does not relate to our inventory, and therefore it goes directly to the income statement. So it's expensed as soon as it is incurred. So that's our operating expenses or selling, general, and administrative expenses. So all those other costs associated with being in business. So this is incurred in other functions of the value chain, not directly related to purchasing or creating inventory. So product costs, those are sometimes referred to as inventory cost. Those are going to be sitting on the balance sheet while we still have that inventory in hand. It's only expensed into the income statement after we sell it to our final customers. And we can see here our total cost, product cost, and period cost kind of diagrammed out. So we start all the way to the left of this where we have our total cost. First, we identify what are our product versus what are our period. And again, as you're going through some of your homework and some of your quizzes, again, this is a good slide to kind of have out. You can see some good examples of your period cost here: R&D, design, marketing, distribution, customer service, etc. Product costs, those break down into two different categories: what hasn't been sold yet and what has been sold. So when we go to our product cost, at first it starts off as our inventory. That's what we're going to be selling to our customers. Any inventory that's sold in the given year, so in this example, sold in 2017, immediately goes to cost of goods sold after it's sold. Inventory that's not sold at the end of the year, that stays on our balance sheet and doesn't go to the income statement until it is sold to our customers, and that might be in the following year or the year after that. So product costs, their first stop is the inventory balance sheet account, and then once it's sold, that's when it goes to the income statement. And it could be same year it was purchased or the year after that or beyond. Period costs, as soon as those bills come in, as soon as those costs are incurred, it's going right to the operating expenses, it's going right to the income statement. So with a merchandising company, and those are the two companies we generally talk about product and period costs, because again, if it's a service company, which is our third type of company that we won't talk to, we won't give a breakdown, there is no inventory, if you remember back to that one of those first slides there at the beginning of the chapter. So with a service company, there is no inventory, therefore there's no product cost, everything is a period cost. But for our merchandising companies, we would have our product cost is the cost of the merchandise itself, any freight to get it from our vendor to our place of business, and any customs, duties, taxes associated paying when we initially buy that merchandise. So that's what is our product cost under our merchandising company. All other expenses, that's going to be period costs. Product cost is the cost of the merchandise itself, plus the cost associated with getting it to our location. When we talk about manufacturing companies, this is where it gets a little bit more complicated, a little bit trickier. And again, we're going to talk about this a lot more in chapters 3, 4, and 5 this semester. But we can see here, we have our three different types of manufacturing costs that go into our product cost. So we have our three categories, and I would suggest writing this down if you're taking notes, or just keeping this slide again starred and highlighted and make sure it's available for you. So when we're talking about manufacturing companies, we have our three different types of product costs. We have our direct materials, direct labor, manufacturing overhead. Three of those combined, that is our product cost, or you'll see a lot of time referred to as that's our manufacturing costs. So if we think about if we're a Toyota again, and we like to use that example here, we have our product cost. Our cost object here would be our Toyota, our Prius, it looks like, based off of the picture. So if we talk about, we have our direct materials, and again, we talked about our direct cost before. So these are something that has to be easy and conveniently traced to our final product, the Prius. So it might be the battery, the tires, the windshield, the engine, etc. Those are all things that we could easily and conveniently trace to our cost object. Our direct labor, that's the employees that are directly working on the Prius. All right, so when we talk about direct labor, first it has to be employees that are related to manufacturing, but then we want to kind of zero in a little more and say it's actually only the employees that are actually working on, kind of hands-on working on that final product. Lastly is our category of manufacturing overhead, and this is basically all the other costs associated with manufacturing but are not easily and conveniently traced to the car. So the cost of the rent for our location, the mortgage interest, the heating, the utility, those would all be costs that support the manufacturing of our car, but they're not easily traced to one individual product. So instead, we put it into a pool, and we're going to divvy that up, and we're going to see that in chapters, again, 3, 4, 5. I keep saying that a lot, but that's where we really talk about our manufacturing overhead. Most businesses spend a lot of time and resources trying to figure out the manufacturing overhead for their business and how it should be allocated to one individual product. Again, companies need to understand how costs are created, how they're spent, how those limited resources are spent in their business, so that way they can make sure that they properly cost out a product, and then once they know the cost, they can know that they're properly charging for their product. So we have our definitions here. I kind of just went through them. Again, they're in your slides, so I'm not going to spend a lot of time here, but just know we have our three manufacturing expense categories: direct material, direct labor, which are direct costs, and then we have our manufacturing overhead, which is basically our indirect materials, indirect labor, and then other incidental manufacturing costs. So these, again, they relate to the manufacturing, however, they're not easy to trace to one individual product, so it kind of comes under this category of manufacturing overhead. Everything else associated with the manufacturing that we can't exactly say, yes, that $75 bill for our lighting relates to these three products. Instead, we just kind of add all that cost up together, and then we're just going to slice it up like it's a pie. So for a manufacturing company, that kind of diagram of our costs, that it gets a little bit, a couple more trees, branches of our tree here. We have our, on the right side in green, the period costs. Those are still going to be the same. It's those operating expenses, the selling cost, the administrative costs, the general cost that associated with running the business. That's still our period cost. Our product cost, though, we get a little bit more detailed. We have direct materials, direct labor, and manufacturing overhead. We also have those indirect materials, indirect labor, and other indirect manufacturing costs that make up that manufacturing overhead. So a lot of the times we focus on manufacturing companies in these accounting classes, and that's really because they have the most complicated set of books, set of rules. They have more formulas and more work that goes into their books, and therefore we want to understand really the most complicated one, and then we can kind of scale down our understanding to a merchandising company and then finally to a service company. But if we understand the most difficult, it's easier to work backwards as opposed to starting with a service company and then trying to build up our knowledge as we go along. So 2 costs we want to keep in mind, and these are really just a breakdown of our 3 manufacturing costs. So we have our prime cost, which all that is that's our direct materials added to our direct labor. And we also have our conversion cost, which is our manufacturing overhead added to our direct labor. So I like to think of it as my primary costs or my prime costs. Those are my big ticket items when we're talking about our manufacturing for an individual product. That's where most of our money is spent. And then our conversion cost is really what the cost that we've incurred to change our raw materials to our finished goods. So that's by adding that manufacturing overhead and adding that labor to our raw materials. So those are 2. Again, you want to just write down those definitions. A lot of the times, I think on your on the homework and on the quiz and on your first exam, what you'll see is a breakdown or a listing of a few costs, and it might ask you what is your prime cost. So you'd have to go through and say which one of these are direct materials, which one of these are direct labor, and then add those together. Same thing, it might say what's your conversion cost. You need to identify what is manufacturing overhead, what's direct labor, add those together. Just be on the lookout that generally on those types of questions, they'll also include stuff like advertising or the bookkeeper cost in there. So they're making sure you don't just add everything together or add all your manufacturing cost or identify everything into one of those 3 categories. They're going to give you that 4th category of operating expenses as well to make sure you understand what should be excluded from my manufacturing cost first, and then we narrow down the field to our types of manufacturing cost. That goes into our prime and conversion cost. Just another thing to keep in mind when we're talking about, and this is going to be more relevant in the real world for the purposes of the chapter and for your homework and quizzes, you're not going to get too deep into this stuff, but just keep in mind when we're talking about a business, the salary and the wage paid to the employees isn't the only cost of having that employee or employing that person. Companies also have to pay fringe benefits, and depending on the type of employee and the type of business and the role, some of these are very large, some of them might be smaller. But there are fringe benefits associated on top of paying your employee a $50,000 salary. You have potentially health insurance. Most businesses pay part of health insurance for their employees, so that way the employee isn't paying 100% of the cost of the premium. A lot of companies will have retirement plans where they provide a match or provide a bonus at the end of the year. Payroll taxes, this is one that every business has. Regardless if you're a part-time employee, you worked 1 hour, you're a salaried employee who's making $100,000. Companies have to pay payroll taxes basically for every dollar you make. They're paying somewhere between, depending on the state, depending on how much that person is making, they're paying somewhere between 7 and 12% on top of your salary in payroll taxes. Paid vacations, again, if you're a Massachusetts employee, they changed the payroll law around here, the employment law. Every employee is entitled to paid time off based off of a number of hours they work. They earn a little bit of paid time off. So you could have employees who are not even working who are getting paid. Again, most full-time employees have some sort of paid vacation or sick days built in. Mass laws have changed, so every employee can earn some sort of paid time off. So if we see here at the bottom, the last point, generally on top of the wage you're paying, so if it's an hourly wage or a salary, companies have to budget and have to think about that it's not just the amount that's in your paycheck. There might be somewhere between 35, 40, maybe as low as 25% of additional cost on top of that hourly wage or that gross salary. So just keep that in mind. For this class, what you might see is an additional a payroll tax. You saw that back in your chapter 1 quiz when we were talking about the farm hands being replaced by the machine. we were looking at not only how much they got paid hourly, but also they looked at how much they got paid in payroll taxes. So you just want to keep that in mind. And those are either cost additions or cost savings if we get rid of or add employees. So next, as we talk about some relevant and irrelevant costs as it relates to making business decisions, what businesses really need to focus on is their controllable costs. So what is management able to influence or change? That's the type of thing we want to spend time trying to make changes for. We want to make the business decisions based around controllable costs. We want to know what our uncontrollable costs are. And generally, uncontrollable costs are short-term, they're uncontrollable. Long-term, generally most costs in a business are avoidable. So this is really when we're talking about business decisions, it's what can we influence or change in the short run. And that might be in the next week, the next month, the next year, the next couple of years, etc. In business terms, eventually every expense, every cost becomes variable or controllable because we can, in the long term, get out of them. We can go out of business, we can move locations, we have options. But in the short term, which is where most of our decisions are being made, we want to identify what can we influence or change, and that's where we want to spend our time and energy on, and then we want to just know what are some of the costs that are going to be locked into in the short run. Those costs, if we're locked into it, we can't do anything about it in the short term. We shouldn't be spending time looking at those or trying to identify those or manipulate those in the short term if we have no control over it. We also want to look at what's our relevant and irrelevant costs. So our relevant costs when we're making decisions, so if we're thinking about making a decision, generally we have to choose between one or two or more than one alternative, so 2, 3, 4 options. What we want to look at, and this is true for businesses as well as in your personal, individual lives, is we want to look at what's my differential costs. And those are the costs that basically differ between our two alternatives. And just keep in mind when we're talking about differential costs, we're not just talking about true dollars and cents costs, we're also talking about the true dollar and cents benefits. So just keep that in mind. It's our differential between between two alternatives or more alternatives. If we're deciding to make a decision, should we buy a piece of machinery? We're trying to decide if we should buy a new piece of machinery, and we looked at there's two options, two pieces of machinery we could potentially buy. If they both cost the same amount of money, we want to look at what's the other differences between, what's the benefit of the first one versus the second one. So if something is the same, we don't want to spend time on that because it doesn't impact our decision. We want to look at what's different between our alternatives. Should we stay or should we go? Should we buy machine 1, machine 2? If you guys are thinking about buying cars, I'm sure most of us have been in the car buying process. Should we buy a new car or used cars? What's some of my benefit? New car, warranty, will generally have a longer life than a used car, stuff like that, better warranty, better newer technology, etc. No one else has owned it. A used car, it might be 3, 4, maybe just a year old, so generally it's going to be cheaper, but someone else has used it, so you don't know the full history of it. If it's an older used car, maybe it doesn't have a long of a life, but it costs less money. So we want to look at what's our differences between our two choices, and we want to make the best decision based on the differential cost or differential benefits. Again, our irrelevant costs, those are that don't change between our alternatives. So if it's a relevant cost or an irrelevant benefit, we don't want to kind of ignore those. If we're thinking about if we have two job offers on the table and they're both going to pay us $25 an hour, we can ignore that revenue, that income level. What we want to focus on are what's the other alternatives or what's the other differences between maybe one you have to drive to Boston versus driving to Providence. So there's a different cost, a different mileage, more time in the car, more gas money, etc. So we identify, and when we're making a decision, what is different between our alternatives, and that's what we want to focus on. Lastly there, we have our sunk costs. And those are basically costs that have already been incurred and cannot be changed. So if we think about back to our example of buying a new car or buying a used car, what we don't want to spend a lot of time on is how much we spent on our current car, because that's a sunk cost. And I think a lot of people, when they're making decisions, they might get hung up on a sunk cost. In reality, it doesn't really make an impact on your decision that you're making about your new car versus, your two alternatives between a new or a used car, how much you spent on your current car. It might have a sense of pride, or, you might feel like I need to get a good price, But in reality, if you spent $10,000 or $20,000 or $30,000 on that car that you're getting rid of now, it really doesn't have much of an impact on what you're buying for your new car. It's already been paid for. You can't go back in time and say, instead of paying $30,000 for my current car, I want to go back and only pay $20,000. Until we invent a time machine, we can't go back and make any change on that. Yes, it might impact some decisions on, if we still have a loan out on it, how much we can afford. But again, the sunk cost in an example is how much we actually paid for that car. Another area where I think it's easy to kind of think about this idea of a sunk cost is if anyone goes and buys stocks or does any trading on some sort of public market for stocks or bonds or investments. A sunk cost is how much we initially paid for our investment. If we paid $500 for a Bitcoin back 3, 4, 5 years ago, and today the market for Bitcoin is $20,000, fantastic, we're going to have a gain. Doesn't really matter from a should I buy or sell transaction or a thinking or a standpoint how much I paid for it. All that really matters in that decision is do I want to buy do I want to sell now at today's market price. Flip side is if we bought it for $20,000 2 weeks ago and then now the crash has happened or the market price has gone down to $10,000, the decision on whether or not I should sell my current position doesn't matter how much I paid for it. It matters how much the market is today for my Bitcoin or for my investment versus what I think it's going to be in the future. Yes, the buying price matters on a tax standpoint, whether or not I have a gain or a loss, but from a decision standpoint, should I sell it today, doesn't really matter how much I paid for it if the market's only willing to say that someone else will buy it for $10,000. Just keep that in mind. And again, it might hurt your pride. It might come into the way of tax planning or decision making that standpoint, and planning for taxes or something like that. But in reality, all you want to look for is what things I can have control over, what things can I change or impact on my decision. And how much you paid for something cannot change. So all that matters is how much can I sell that item for, whether it's an investment, a car, or whatever. So lastly, we're going to go and we're going to look at how to classify our cost as either fixed or variable and calculate some of our costs. So cost behavior is so important with understanding. When we're looking at a business, when we're looking at whether you're an employee, you're starting a business, you're the owner of the business, it's so important to understand how costs behave. Most common cost behaviors, variable, fixed, or mixed, and we're going to get to those right now. So right here, it's a diagram. This is not actually in your slides. Whether it's only going to be in this presentation. It's not actually in the slides from Pearson. I took this from another book, but it's so important. I would highly recommend either saving this or writing this down, and I'm going to spend a little bit of time talking about it. So it's going to be up for a while here, at least a minute or so. So our cost behavior within a relevant range, and we'll get to that a little bit when we get into chapter 6 slides. But here we're talking about our two different types of costs that we're going to focus on. And I said there's 3, fixed, variable, which are here, and then mixed. But mixed is just basically combining these two together. So if we understand what's a variable cost and what's a fixed cost, we can then put those together for our mixed cost. So for our variable cost, and that's the row in blue here, we have 2 different ways we're going to look at them, in total and on a per unit basis. So variable costs, in total, those are going to increase or decrease in direct proportion to our change in activity level. However, on a per unit basis, our variable cost per unit is going to remain the same. It's a constant. So if you think about that, if we think about variable costs, we're thinking about, I like to use the example of a vending machine. I think everyone has used a vending machine. They've gotten a snack, or they've gotten a soda, or they've gotten, if you're at the bowling alley, a pair of socks from a vending machine. Those prices are set. The vending machine, whoever's running that, the business, they go and say, every one of our sodas is going to cost us, or it costs the customer, $2. So the cost per unit, that's constant. It's always going to be $2 within that relevant range, which is what we're going to talk about a little bit later. But as long as it's set for $2, every time you push that button in the vending machine, it's $2. $2. You buy one, $2. You buy 2, it's $4, but each one is 2. So the constant, the variable cost per unit remains the same. However, as we buy more, as we push the button more, $2, $4, $6, $8, $10. As we buy more soda, it costs us more money. If we walk right by the vending machine and we buy nothing, it costs us $0. So the more we buy, the more cost we have. The less we buy, the less cost we have. That's our variable cost. Fixed cost, on the other hand, so it flips around basically. In total, our fixed cost stays the same. Doesn't matter how much activity we have. Within our relevant range, it's going to be the same. Whether we make 1 unit, 2 units, 5 units, 1,000 units, it's going to stay the same. However, on a per unit basis, the fixed cost per unit is going to decrease or increase in an inverse relationship to the amount of activity we have. So for fixed cost to kind of think about and picture is, if anyone here has ever had rented an apartment from a landlord, they set the rent at, say, $1,000 a week. And if you have any sort of roommates, you'll understand that the more roommates you have, the more people are sharing in that cost. So in that scenario, our landlord might say, as long as you don't have more than 5 roommates, it's $1,000. So our relevant range would be, as long as we stay under 5 roommates, we're paying $1,000. So our cost is the same, and if it's just us renting in that apartment, we're going to pay $1,000. But if we add a second roommate, we're now only paying $500 each. Landlord still gets $1,000. If we add another roommate, $300 or so each, so on and so forth. So as we grow that number of roommates, the individual cost, or the cost per unit, is decreasing. If we start saying, all right, there's 5 of us, $200 each, however, it's not enough space, we're going to start getting rid of a roommate. If we start to lose roommates, each one of us picks up more and more cost, more and more rent per person. Again, landlord's still going to get the $1,000. It's just going to be, am I paying $1,000 or $500 or $300 or $200, etc. Or going back the other way, as I lose roommates, I have to pay more and more because I pick up their slack. So variable costs, in total, up or down in a direct relationship to the activity, per unit stays the same. And if you draw a little diagram, I like to do variable costs, and then in total, arrow up or down, per unit same. Fixed cost, in total same, per unit up or down, because those are the ones that are changing. So our in total variable changes, our fixed per unit change, our fixed in total is the same, our variable per unit is the same. So we can see that. And it's important to understand how those costs behave, goes ups, goes downs, and how that impacts our decisions. And why this isn't so important is, as we go through, we really understand how our activity works, and we can understand and we can predict, based off of changes to our business, what's going to happen to our costs, etc. So here we have our fixed cost, and we can see that, in theory, the graphing it out visually, it doesn't matter how many miles we drive, the insurance cost per year is going to stay the same. It's $1,788. Again, on a year-to-year basis, it might change if we get into a car accident or if we have no incidences. It might go up or down year to year. But basically, once we sign that contract, if we drive no miles or if we drive 10,000 miles, we still have to pay that one single fixed fee. Variable cost, again, gasoline cost per year. And we can see if we don't drive our car at all, we pay nothing in gas because we didn't use any. As we use more and more mileage, though, we're going to have to buy more and more gas because we're using up that resource. So a couple of different things for manufacturers, how costs behave. Direct material and direct labor, those are generally treated as variable costs. If we think about our direct materials and our direct labor, if we're making a bunch of products, we have to buy a bunch of raw material. We have to pay our employees to make those products. If we are scaling down our business, we're buying less raw materials and we have less employees working. Manufacturing overhead is generally a mixture of fixed and variable. We might have, for our indirect materials, we might be using more as we make more, use less as we make less. But there's certain things that fall under our manufacturing overhead that really our rent, our utilities, the supervisor's salary. Some of those are going to be a fixed cost in nature. So altogether, our product cost is going to be a mixture of those variable costs of our materials and labor and our fixed costs of our manufacturing overhead. So a couple definitions and a couple formulas. Our total cost, that's the total fixed cost plus our variable cost per unit times the number of units sold. And we can see here in our example, our fixed cost is 20 million, our variable cost is 5,000 per vehicle, and the number of units equals 10,000 vehicles. So we plug that in. It's our fixed cost of 20 million plus our variable cost per vehicle times the number of vehicles gives us our total cost. And we'll see here in chapter 6, which we're about to get to, our formula would be F plus our V, which is our variable cost per unit, times our X, which is the number of units, to get to our total cost. Basically, it's like the function of line, the slope of a line, etc. Our average cost, and this is important because a lot of the times in homeworks or in the quiz or on the exam, you'll be given, here is our average cost per unit, what's our total cost, or sometimes they might work backwards. Here's our total cost, the number of units, what's our average cost. So you have to be able to go back and forth between those two. So our formula there, it's our total cost divided by the number of units to equal our average. So how much does each individual unit cost us to produce? Lastly, we have our marginal cost, and that's the cost of making one more additional unit. So fixed cost will not change if one more unit is made, unless the plant capacity is already operating at 100% capacity. Just keep that in mind as you're thinking about that marginal cost. When we say a marginal cost, it's generally what's the additional variable costs, with the caveat that sometimes we get to a point where our plant is 100% filled, so in order to make one more product, we'd have to get additional space. But for the most part, marginal cost, that's the variable cost associated with our manufacturing process. All right, so here we're going to go on to chapter 6, but what I'm going to do is I'm going to stop the presentation here. That way you have two different presentations you can look at. That way if you want to get to the end and come back to another one. So we're going to stop here at chapter 6. There'll be another link. You should see it on the My Courses page where you pick up on chapter 6. This way you can take a natural break and go on and keep going. So I'm just going to stop here.